Hey everybody, it's Michael Martin. Thanks for being here. So, wanted to say thank you again for all the great feedback, all the great comments. I read everything and I try to respond to as many of you as possible. If you have something that's a little bit more private, there's a link in the description if you want to reach out for suggesting a topic, or if you wanted to discuss coaching, there's a link in the description. Also get the audiobook download. So there's four things that typically come up when I do get emails about, people and their trading and what they're trying to overcome. And it has to deal with the fear. It seems like the greed kind of takes care of itself. It's probably why you're in it. Anyway, I personally don't think it's probably greed. I think that's what most people are talking about in, retail space, fear and greed. I think, when you come to the marketplace, you're definitely looking at, trying to find some sense of financial abundance. You know what I'm saying? But there's four things that I've noticed, and I wanted to talk to you about those today, that you need to kind of overcome or understand and adjust your trading tactics, right, for these types of these four aspects. First one is fear of missing out. How does this show up in your trading? Well, for one, if you don't have any defined entry criteria, right, you might be just going on social media and which isn't exactly research, and seeing what everybody else is doing. You have an emotional need to kind of want to fit in. And you certainly don't want to lose money by being an outlier or doing, which is, to me, the absolute wrong thing to do, because you want to do your own research. Studying Yahoo Finance or looking on StockTwits, interesting stuff for sure, but that doesn't qualify as research. So also chasing, right? You didn't get into Bitcoin when it traded down to the 80s, the 80,000s, or 90,000s, and now that it's up, or at least it was last week, it was up over 100K again, or the GBTC, you start to chase because you have the fear of missing out. And that's a tough way to go about it as well, because you can't take the pain then of not participating, which is kind of like a gamble on some level, right? So how do you solve that? Because that's really the issue. You solve it by saying, okay, I'm going to buy a 40-day breakout. I'm going to buy when the 5 crosses the 20-day moving average. I'm going to buy a pullback to an exponential moving average, and then buy the retracement when it starts to tick back up. I'm going to borrow from, Brian Shannon and not buy anything unless it's over its 5-day simple moving average, like stuff like that. Is it making new highs? Are you buying with other buyers? And when new highs are being made, is the volume like, 120 or so plus percent of the average, for example. So you have a definitive rule. Now, there's a million ways to slice it up. These aren't definitive, but they're a good starting point if you don't know what you're doing. And then if those things don't show up, then at least you have a reason for sitting on your hands and not jumping into the marketplace. And you could do it for any instrument. The second one is fear of losing money. Well, what you want to make, and like, how do you want trading to serve you? Like, what is it there for? Is it a vehicle? Like they say, what is a cigarette? It's a nicotine delivery device, right? So what is trading in that mindset? What is trading? How does it serve you? What is it there for? If it's just to make you nervous about money, I would stop trading, right? Because professionals, the difference between professionals and retail is that the professionals know that they have organized and deliberate behavior of where and what and why and how they're going to add risk and how they're going to remove risk. In certain circumstances, they might even add more risk, right? You do that in angel investing. You could do that in venture capital as well. So if you have a fear of losing money, you have to figure out, like, why are you coming into trading then? Because there's always going to be a level of uncertainty that's inescapable. Now, you can continue to develop your model so that you can understand the concept of mathematical expectation and what the probabilistic outcomes are, knowing that we have imperfect information. And that's the best case. So as a trader, losing money is part of the business. The key is to keep those obviously as infrequently as possible. You're still going to probably lose at least half the time. But when you do lose, make sure that they're paper cuts. You see? Where does it show up in your trading? Well, oftentimes you could be trading too small. You might be trading like, one MNQ and risking 10 points and not really sitting in the trade long enough, knowing what the natural volatility of the instrument is, perhaps measured by, say, 20-day ATR, and not putting enough risk on so that when you do make money, it makes sense for all the work that you're putting in, right? You have to look at this and say, am I getting paid? What is my worth? Not just my self-worth as a human being, but what is my worth as a trader? Why am I not wanting to compensate myself for everything that I'm worth? Right? I did another video, you can look it up, like don't get comfortable taking small gains. You always want to be uncomfortable in that space and realize like, hey, I deserve to get paid for the work that I'm doing and for the risk that I'm taking. But it is possible to not hit your financial goals because you're actually not risking enough. How do you know? Well, go back and look at your trades and see what the expected value is. Then what you can do is look at the trades and how they worked out after you offset the trade, right? Could you have stayed in the position longer? Could you have adjusted your protective stop higher, like at least to break even and then above break even, so that if the market kind of continued to move in your favor, you continue to move your protective stop up so that if and when it eventually does reverse, you'll get knocked out, but for bigger gains than you would have taken if you just had this hair trigger response to always offset winning trades with small gains, right? So trading too small is a real problem. A lot of people do it. Why? I don't know. My guess is because they want the next thing. The third one is the fear of being wrong. They can't take it personally. They were academics. They were super bright students. They might have had honors APs. They might have designations in other areas of their life. And they're just not used to being wrong. It's very foreign to them. They were great students. You're a great student. I understand it. I was a good student. But you have to coach yourself to understand that we're living in a world of expected values and uncertainty and incomplete information. Not just imperfect, but we have incomplete information. And we're trying to make decisions and manage risk in the face of all of that. And at the same time, fight a million years of evolution where we have fight or flight mechanism built into our natural behavior, right? So it's not the natural order of things for us to go towards risk, right? That's what military, firemen, EMTs, police, right? It's a different mindset. It's a different function. So if you kind of learn a little bit more about the math and understand, even take out a piece of paper in your notebook and start to spell it out and say, okay, what happens if I have a trading model where I'm going to make, say, $500 on my winners, I'm going to lose $100 on my losers, and then say, okay, if I do 10 trades, right, and 4 of them make me $500, multiply that out, right, and then 6 of them are going to lose, and then multiply that out, and then net everything out and see how much money you make. And you got to learn to be comfortable with an accuracy rate that might be below 50-50 or 50%, and an accuracy rate that if you were going to judge you and grade you like it was a test in school it's abject failure. Let's face it, you get a 40%, that's worse than random. Because, if you're taking a 50-question true or false and you're completely guessing, you only have 2 choices, right? You have, if you did that many, many times, chances are you'd be close to getting 50%, right? Because there's only 2 choices, 50 true or 50% true, 50% false. So if you went through a 100 question type of thing like that, you should be close to the mean if you did it many, many times. So if you were completely guessing, right, and you got 40%, that would be worse than random. So learn to get comfortable with infrequent wins. The reason why that makes sense and why it satisfies the thing about trading too small and why it works is the asymmetry in the winner to loser, right? So that's what people don't understand, is that they come to the market, or as they're even trying to build out their own trading models, they have the frequency of win is what's validating. What should be validating is the asymmetry between the winner and the loser. And you can see enough on the chart where you get in and you measure up to the next previous high, how much is that, how many points, right? So if it's 50 points away and you risk 10 points on a trade, there's your 5 to 1, right? Just make sure that your protective stop is going to be put in a place where, it makes sense, where you know for sure, like if you're trailing structure or trailing percentage stops, so that you know that it makes sense, because we're not just making up those numbers. Now, if you look and you see a trade where there's only 10 points of upside before the next level of resistance, and you have 10 points of risk, that's 1-to-1. Those models have to be super accurate, like 70, 80%, in order for those to make money for you, right? So those aren't a good fit. It means to me that there's no trade, despite what you might be reading or seeing on TV. So now you have this process of elimination, and that if you can't see minimum 3-to-1, if not 5-to-1 in the chart, then there's no trade. There's no reason to do it. So there's no FOMO, because the numbers aren't there. Now, it will take you some time to trade and get actual numbers, right? Maybe, I don't know that paper trading is going to work here, because you really have to feel the burn with real money, in my humble opinion. But, after speaking with all the people that advise you, your financial advisors, whoever that might be, you can determine what and how much to risk and what would make sense for you. So being wrong also, just if you need someone to tell you, it doesn't say anything about your intelligence, because in the short term, for everybody, from me to you to Paul Tudor Jones, there's an enormous amount of randomness that is involved in the market, and it's always there. It's not going to go away. So you can kind of forgive yourself, even though you might find it annoying, it's not practical to think that you're going to come to the market and all of a sudden be absolved of having to deal with randomness. And bad timing's never going to happen to you, and for sure you're never going to have bad analysis. You should get comfortable with the idea that you're probably going to lose 5 to 6 times for every trade, every 10 trades that you put on. There's no way to buy your way into something more accurate. The indicators aren't going to help you. They're all lagging indicators, right? They can only help you confirm stuff that you could already see in the price. There's nothing that's very predictive about that. So that's the good news. If you look at my charts, there's no overlays, because they're all basically useless. I call them emotional band-aids, at least I did in the book, and I still think that's a really good way of looking at them, is that you're trying to avoid the uncertainty that goes along with trading. So if you just put on one more indicator, one RSI, one ADX, one MACD, Bollinger Bands, that to me shows signs of desperation, and an unwillingness to embrace the uncertainty. Remember, uncertainty means risk. It's financial risk, but it's also emotional risk. And if you find yourself grappling with the emotional side, you're always going to undermine yourself. I would bet against you. And I don't mean to sound that way. Why do I do the show for free? It's to help you understand these things. But I wouldn't allocate money to someone who's not sure-footed and who doesn't understand that, in many ways, this is almost as bad as angel investing. You're giving money to people where you kind of really, even though the idea sounds good, how they say on Wall Street, you bet on the horse, you bet on the jockey. The horse being the company, the jockey being the manager or the trader or the CEO. If you can't control your own behavior, it doesn't matter how good the idea is. It even doesn't matter how much money you think you want to make. If you can't control and I know there's marketers out there take advantage of this and say, you have to try if you buy this trade at XYZ time in the afternoon, and swing trading is the only way to go. And investors are like, well, Warren Buffett did value investing, so that's the only thing that matters. There is no man for all seasons. Every trading strategy is going to have its day in the sun, right? And in bull markets, everything looks good, right? So it's even harder to judge talent. So the idea here is that you want to try to find a methodology that's going to feel good for you, that you can replicate day after day after day. And if you don't see the setups, especially these big asymmetric ones, then there's no reason to trade, because now the payoff is suboptimal. And that's something that you can see pre-trade. I want to cover the fourth one, and then I'll come back and revisit some of these as the ideas pop into my head. This is the ideas popping into my head. This is what it looks like. The other one is I have a fear of leaving money on the table. And how does that show up in your trading? Well, off the top of my head, it's people who scale out of winners. It's not my style. when the party's over, guess what? Get the hell out of my house. I'm going to bed. I got stuff to do. And so to me, that again, do what you want, but what happens when you're in a trade, it goes up a certain point, you have in your protective stop. If the market's going to turn around, why would it make sense to have any inventory? Do you have reluctance to sell the entire position because you don't want to feel like an idiot, which speaks to another one of these ideas, in that you buy something at 16, it goes to 22, you get stopped at 21, and it goes to 23, 24. You feel bad about that? Again, come back to the asymmetry. If you were had one risk unit and you could make 5R as your estimation when you look at where the chart could go, right? In other words, the longer term or the higher time frame breakouts are probably better for you. Historic highs might even be better, because then there is nothing, when you look at the chart and you look to the left, I don't know if this is your left or this is the left, there's nothing but clear blue sky. And some of you might have reluctance because you're like, man, I can't buy it at historic highs. At that point, I missed a move. Remember that when the chart's in the top right corner, that's not the ultimate point. It's just the HTML or the JavaScript that shows where the chart is now. But in order for the thing to have made highs a few weeks ago, those prices were still, like, say a stock had a historic high of 35 and it trades to 40. And now that's in the top right corner. If it goes to 50, like, you can trace back, and then it goes to 60 and you're like, oh, I get it. All these highs were in the top right corner. So to me, it's like, and Sean McLaughlin and JC Peretz, they always pull my leg and like, what's Mike Martin's buy signal? If it's in the top right corner, it's a buy. And in many ways, you can start to look at that. If you break the chart into quadrants, if it's in the southwest quadrant, it's an avoid or it's a short. It's not a value play, right? Don't buy weakness, because you could still lose 100% of what you put in. So leaving money on the table, there's no, again, value investors will debate me on this, but we're talking trading now. Lower prices mean lower market cap. Doesn't mean better value. Now, if you're an investor, that's a different ball of wax. But if you're a trader, lower prices mean lower market cap. It doesn't mean better value or a better place to buy, right? I was in a sugar trade way back 20 years ago where the thing was breaking out from 9, 10, 11. I was loading up. It went to like 15 almost before it backed off. I get stopped at 14.50. And then I noticed, because we're coming into January of that year and we're trading the March contracts, we still had many months to go before I'd have to roll into the what would have been the May Ks of the next one in the term structure. It was consolidating and it wasn't coming down after a 30% run up, which is a sizable move for a commodity, and it started to break back out to the upside. And I was adding between 15 and 16. So, imagine getting in at 9, 10, 11, running it up to 15, getting stopped at 14, and then buying above those prices. All the prices are relative. If you buy something you can't compare 14.50 to 15.16 because it's not predictive, right? You don't know where it's going to go. It could go to 25. And so you can't worry about like, well, I want to get back in where I got out. That dog ran away. It's not coming back. Sorry. Right? That moment in time came and went. So, you could say leaving money on the table is also, trading too small. Now, I do run into that from time to time because of the way I nibble into my winners. I kind of nibble into the winners and I'll keep adding 5, 6, 7, 8, 9, 10 times, adjusting my protective stop along the way, again, to move all of the inventory. I don't scale in and I don't scale out. But in order to, what I want to do is build unrealized gains, and then I'll reinvest those gains into my protective stop. So this way, by the time, if it goes the right way, it looks like I have almost a free call option. If I get knocked out, I'll make some money. I won't make as much as I want, but it's life on life's terms. And I know if I just replicate that process over and over and over again, I'll continue to have very, very strong ratios in terms of the average winner to the average loser. That's really what you're trying to measure yourself on, is how big is your average winner to how big is your average loser. And if you can get to that spot where you're at least 2 to 1, if not 5 to 1, you know, of a certain percentage, right? Because that's what's the key afterwards. It's that the expected value is the frequency that you make and lose money, and then what's the magnitude of the gains and losses. So you must, find that asymmetry. And if the asymmetry is not there, there's no point in putting on the risk, because you know that you can always lose whatever your risk unit is. If forget even bad analysis, you could just have bad luck or bad timing. So you have to sit and be a little bit more disciplined. It's going to be harder to do if you're really just trying to day trade stock index futures. There's limited opportunities there. There'll be a lot of days, if you do it how I'm saying here, that you'll be sitting on your hands and letting several days go by because the setup's just not there. But that to me is one of the single most important things that you can do for your trading, is to say, okay, if I'm risking 10 cents, I need to see 50 cents to the upside. If I'm risking $1, I need to see a minimum $5. If my R is $5, or in whatever percent that is to your capital, right? Then I need to see, if I don't see 15, there's no point in even putting on the trade, right? Because I don't have like a scalp unit, a morning unit, a lunch break unit. I don't have any of that. There's one risk, it's risk on, and that's it. And then I eventually try to build into my winners. Why? Well, when you study finance, you realize along the x-axis is the number of stocks, and then the y-axis would be what we call unsystematic risk. At the number 1, you'll see a horizontal line that represents market risk or systematic risk, and that doesn't go anywhere. And when you start to add names to the portfolio across the x-axis, and you see the unsystematic risk line starts to decrease rather aggressively and becomes asymptotic with market risk. So in other words, you can diversify away risk from the unsystematic risk. You can hedge market risk, but you can't diversify away from it because it's always going to be there if you have positions. So when you look at what are the amount of you start to add certain numbers of positions, you get diminishing returns on your diversification. In other words, the incremental benefit of adding a 14th name to the portfolio after you've already had 13, you might have some upside, but the diversification benefit and risk reduction doesn't necessarily pay you. And that number it depends, admittedly, because it's a personal thing, how you feel about risk. You can start to see what is it called? Concavity, I suppose, of the curve change a little bit when you get to 5 or 6 names. So let's keep the math easy. You have to figure out what's your allocation and what's your risk unit. But I learned because again, I had a small account and I know I needed to really grow my assets in a sizable way. I started to think like, okay, I have, my pishy little $5,000 account, I have 5 blocks of $1,000. And that's what I really have to think about risking. I have too little money, but I knew if the money would grow, then it would grow away from my starting balance, which was the goal. So you can even do that, today when I consult with people, they're like, well, I got to, they're not taking enough risk because they're thinking about these 4 things. They don't want to chase. They don't have a plan. So have a plan, then you won't chase. I don't want to lose money. Well, think about how much you want to make and then what the ratio is, right? Because then it makes it sound more reasonable. If you always look from a standpoint of fear, it's hard to be a good trader if you're in fear. Maybe investing would be better for you. I don't know. But I do know this, and that is if you don't trade large enough, you're not going to hit your financial goals, right? So when financial planners sit down with people, they talk about how many dependents you have, what's your liquid net worth, when do you want to retire, what kind of overhead do you have, are you taking care of retired, 2 sets of retired parents while you're saving for your retirement and you're trying to save money for your kids' education, like the sandwich generation. So you have to make sure that you're taking on enough risk to grow your money so that the whole thing makes sense. In other words, it doesn't make sense to try to grow your money in stocks if you're getting treasury bill-like rates of return. Because you could get the same return for less risk and less work. You just put your money in and let it go. Protective stops, they are a way of life. So don't worry about being wrong. Make sure that that you know exactly where you're willing to transfer the risk to other people. at the end of the day, this is going to help you learn to live with the uncertainty that comes with trying to manage risk in the marketplace. It's never really going to go away. So what you have to do is, I don't want to say build a hardened shell against it, because that would mean that you're not willing, to experience this thing. And you're looking at a guy who is willing to feel every feeling. And that's where you need to get, where the feelings that you feel, you can't internalize them and try to intellectualize them and think like a psychologist. My God, if you need a psychologist for this business, don't do it. It's not worth the aggravation or the suffering. It's not worth it. There's other ways to make money that you can do very, very well in, right? You could be an investor. You could do real estate. You could collect baseball cards. There's a lot of ways to grow your money. Trading is not necessarily a panacea. You really have to have the right when people say you need to have the right temperament, this is really what they mean. Can you be a smart person? At least I'm above average, right? If you ask people how smart they are, you average? No, I'm a little bit above average, yeah. And learn to live with that uncertainty and understand that you're going to be putting on hundreds, perhaps thousands of trades over a certain window of time, and any number of them don't really say anything about you, to the extent that you don't lose control. If you're acting out of emotion, then you're on tilt, and that typically doesn't serve you. You can't really trade your way out of a drawdown when you're on tilt. It only makes things worse. So think about this. Don't worry about leaving money on the table. It's always going to happen. There's a saying in angel investing that how do you make money in angel investing is like you have to sell too early. There's been plenty of companies that raised lots of money that went into Series A, Series B, had venture capital money coming in, and never really had an exit. They never got acquired, and they just never made any money. They went out of business. So, and that's going to happen. Fear of missing out. Know who, what, when, where, why, and how you're going to get into your trade, and stick to those rules. Asking yourself, is now the right time, is something that you can satisfy if you just say, I'm going to buy a 10-day breakout. And that's my entry rule. Pretty simple. Now, you can backtest all of that too and marry it with your bet size and the frequency with which you lose, so that you can see, does that make sense? The key is that when you look at money management, you need to have those components. What's your bet size? What's your entry? And what's your loss? Or your protective stop. That's really what makes for the money management, is knowing all three. You can't determine any number of them on the fly. You need to have those three things defined before you even put on the risk, right? So these are things that you'll learn to become comfortable with, because as a trader, it's a way of life. It doesn't say anything about you in terms of intelligence. It doesn't mean you're a loser. It doesn't mean any of that. Right? You got to be kind to yourself, and you have to understand that you're going to win infrequently, but when you do win, make sure that you get the asymmetric payoff. Questions or comments? I'm open to everything. Check out the links in the description. Have a great week, folks. I'll see you next time.